Okay, let's look at what the factors are that are going to influence the rates that you're going to have access to, right? Because the truth is that as any borrower walking around, they have access. You actually have access to a range of different rates, and so as we identify these different factors, we're going to hone in on what the real rates are that you're going to have access to. All right. So one of those factors is one of the main ones is the intended use of the property. Is it going to be for your primary home? Is it a second home or vacation home for you, or is it an investment property? Another factor is what type of loan program. Are we talking conventional loan program? Are we going to go with a government loan program like FHA, VA, USDA? Or are we talking like non-QM, those kinds of loan programs that are, for alternate types of income sources to repay the loan? That's called non-QM. Another factor is the location of the property. This can be all the way down to, it's the state, it's even down to the zip code. Another factor is obviously going to be credit score, right? The higher your FICO score, the less risk a lender is going to see in you being able to repay that loan. So you're going to have access to lower rates, right? Credit is a moving target. We'll talk about some tips to get that credit score up as high as possible so you can have the lowest and best rate, but credit score obviously going to be a huge factor. There's also the size of your down payment, right? Sometimes in the biz, that's called loan to value. Usually, the more money you put down, typically the lower the interest rate's going to be, right? Then we've got property type, right? Is it a single family home or a condominium or a multi-unit? Of all those different types, your single family home scenarios are going to have the lowest rates versus condominiums, because that's a form of shared ownership, right? It's like a bunch of different people all kind of sharing ownership of a structure. And then multi-units, of all those different scenarios, the single family is going to have the lower rate. Then we've got debt to income ratio, which is basically how much of your income that you're using to repay the loan, how much of that income is going towards debt. If it's below 40%, including the new mortgage, if your debt to income ratio is 40% or below, you're probably in good shape to have the lowest rate available to you. If we go over 40%, you're going to see a hit on that rate. Then we've got loan term, or how long is the loan going to be for? Is it going to be for 30 years, 40 years, which is now a thing, right? Or is it going to be for 15 or 20 years? So if the difference in how long you have to repay the loan could affect the interest rate as well.